A lot of people have talked about the loss of the American dream, but here's a reason why owning a home may not be nearly as dreamy as it's cracked up to be.
The basic return on housing net of inflation is almost zero. A lot of people who argue that you should buy a house to build wealth, what they're really saying is pay me because I'm a broker. And often what they'll say is, yeah, but if you buy a house, that's a levered investment because you're borrowing most of the money to buy the house. And that's fine, but it's a levered investment in a very low return asset.
That's Brad Case, chief economist at Middleburg Communities. And he's making the case that if you want to build wealth, you might want to rent rather than own a home. It turns some other common financial thinking on its ear, and it's all part of today's big interview. But up first, Charles Rotblut, editor at AAII Journal, will be here talking about how there's been a change in investor sentiment, but also there's been a change in the way that AAII is using sentiment to inform investors and make investment decisions. Plus, David Traynor, president at New Constructs, is here, following up on last week when he put a company in the danger zone because it was highly likely to miss earnings. Well, today he's going the opposite route and talking about something that's attractive because it's likely to beat earnings expectations.
Shazam!
Oh yeah, say the magic words and we are off to the races. This is Money Life for July the 14th. Thank you so much for joining me. I hope you had a great weekend. Gail and I spent some time on Saturday at the Levitate Music Festival watching the Revivalists and Ripe, two of our absolute favorite bands. Among others, there were some other things there, but it was a fun but long day. There comes a certain point where you might want to go music festivals. Do I still want to do them? And we may be getting to that point. Gail has a birthday coming this week. I had a birthday last month. So, every year you get a little older and you go, yeah, is this as fun? And we had a great time. And at the same point, it's a long day. But we also got a ton of stuff done over the course of the weekend. That was a lot of fun, and it sets us up for a great week ahead. And that's not just a great week ahead for us personally. It should be a great week for this show. So I'm glad you're here. We've got big things. I will point out to you up front that Brad Case works for Middleburg Communities, which basically makes rental properties. So an economist working for a company that makes rental properties saying you might want to rent rather than own shouldn't necessarily surprise you. At the same time, he makes that case with real numbers, and they are real numbers that I've known about for a long time. And, look, to me, there's no one right answer, right? I think a lot of people want to own a home. It's very important for them to own a home, or they're not going to behave in ways that make sense when it comes to, you could make more money if you rented and you put the money aside. Yes, but they're not going to put the money aside. They're not going to do the things they have to do to make that work. I believe that there are plenty of people who save money in part because they force themselves to save money, maybe not doing the most efficient things. I always have told the story of my father-in-law, my late father-in-law. He always said he didn't love saving, but he loved paying his bills and never wanted to be late. So one of the things he did was he saved with life insurance. Now, he saved in other ways, but life insurance was a huge part of it. And as he pointed out, other things didn't happen until much later in life. So he was building wealth for a long time by simply paying life insurance and treating it like a bill. And so you can make a case, is life insurance the best thing you could do for your money? You could make more money doing something else. Sure, but would you? And that's an important thing if you're looking at this. But I think that there's something else, which is, I've talked to a lot of young people, and although my daughter Whitney, she and her husband Greg have a house, my daughter Thompson recently moved from one apartment to another. And she talked about how she doesn't know that she'll ever own a home. And she said, is that a bad thing? And we had a discussion about, no, it's not a bad thing at all. But the question is, can you build wealth without owning a home? And the answer is yes, you can, but you have to have good behaviors. You have to do the things that are going to give you the positive outcomes that Brad Case makes the case for when we have our discussion. So it's an interesting one there, not necessarily our standard fare, but we have a lot else going on today. Charles Rotblut, always great to have him back on the show, talking about some things with investor sentiment and the sentiment of investors. Well, today is going to be interesting to watch because, of course, we got more tariff news, and it is certainly expected the market will open down today. The futures were all pointing towards everything in a down direction after we had the tariffs, etc. But opening down doesn't mean they'll stay down. It's going to be very interesting to see what happens. But yeah, I would not only expect the market to open down, but I would expect Bitcoin to go up in response to this, because you add the uncertainty, you do the other things. And this is one of those cases where, although Bitcoin at times has been very correlated to the market, it's not always correlated to the market. This would be one of those cases where you'd go, okay, if I had to predict the opening, which is kind of a meaningless prediction because by the time we get to noon, who cares anymore? But you should not be surprised if the market opens down this week, and particularly down in the early portion of trading today. I'm Chuck Jaffe, financial columnist and your host here on Money Life. This show is independent personal finance talk. We are dedicated to looking smartly at a wide range of approaches and opinions on investing. It is not just about what I like, it's about what you can learn from, and we hope you will learn. But if we can help you learn more, if there's guests you want to hear on the show, if there's anything we can do, Chuck at MoneyLifeShow.com is how you reach me. Don't be shy about reaching out. But right now, we're not going to be shy about jumping into the action. I've told you what's coming. It starts with Charles Rotblut, and it starts right after this message.
Asset managers, you know how hard it is to stand out in this crowded space. Vetify is a unique partner that can help you across the entire product lifecycle. With a best-in-class index factory and an award-winning digital marketing team, Vetify can help you build the products of your dreams, optimize your distribution efforts, and grow your assets under management. Learn more at Vetify.com.
We start this week with the other interview on today's show. Returning to Money Life now, Charles Rotblut. He's editor of AAII Journal. He's the author of a book, Better Good Than Lucky, which, by the way, it's now been out a couple of years. Still worth looking at and reading because it all applies to what's going on today. And if you want to learn more about what he does, well, it's AAII.com. He also was in charge of their sentiment survey. That would be AAII.com/sentiment survey. We're going to talk a little bit about the sentiment survey, but we're not focused entirely on that. That's why we're calling this the other interview. But any day that we get to talk to Charles about anything, it's a good day. So, Charles Rotblut, good day. Welcome back to Money Life.
Thanks for having me, Chuck. Always a pleasure.
I do want to start with the sentiment survey, but I want to start in two ways. I want to talk a little bit about sentiment, but I also want to talk about the fact that AAII now has just debuted what they call sentiment investing, AAII sentiment investing. So let's start with sentiment investing, and then let's talk about where sentiment levels are.
Sure, absolutely.
Explain how sentiment investing works.
So sentiment investing provides investors insights into the market's mood. So we're not trying to predict where the market is. We're trying to show investors, is the market very bullish right now? Is it very bearish right now? Or is it neutral? And so we're building off of our sentiment survey, the AAII sentiment survey, which we've seen extremes, and you and I have talked about when bearish sentiment gets too high, bullish sentiment gets too high, or the reverse, we tend to see market reversals. But one of the things we believe in, and I myself believe in this too, is that investors should form a mosaic. And so you often see people talk about, oh, this indicator's flashing bullish or this indicator's flashing bearish, but it's always just one indicator. No indicator has a single track record. But what we do tend to see at market extremes, or even when the market gets a little out of whack, is we tend to see multiple indicators pointing one direction or the other. And so if you can see a broad mosaic about it going forward, say you see sentiment being overly bearish, you see short interest spiking up, perhaps you see the VIX rising. The VIX is a CBOE's volatility index. That might be a sign that people are feeling really bearish and perhaps there's too high a level of fear. Now, I do want to say this isn't about market timing. This isn't about trying to time the right time to get in stocks or out of stocks, but it's more to think about tactical decisions with your portfolio. Do you need to rebalance? Do you have a buy list you've been sitting on and you want to look perhaps for bargains? Or the one thing that always irks me, and I'm sure you've heard this many times too, or not heard this many times, is whenever we hear about market correction, few people come on and say, now's the time to do your Roth IRA conversion. But anytime the market really does a big pullback, that's the ideal time to do your Roth IRA conversion because those things are on sale. So the whole idea about gauging market sentiments to try and get a sense, is there a turning point? And is there something you were already planning to do or looking for an opportunity to do? Use that to your advantage. But you can also use it just psychologically, that if you're feeling really nervous, you can look at it and say, okay, I realize other people are feeling nervous, but I realize this is probably getting to a turning point, so I should stay in it. Or if you start seeing markets going really too much in terms of being bullish and you're sitting on stocks with big gains, their valuations are beyond stretch what you would do for your strategy, maybe it's a sign for you to take a look at your list and saying, this stock's done really well. Is its valuation overstretched? Should it be time for me to perhaps take some profits and then look for other ways to put my money to work? So again, not trying to time when the market's going to go back or forth, but really get a sense to, when is it too much underwater and maybe when is it too overstretched?
Yeah, it's really taking the information that you guys have had for years and saying you've now seen enough that you think it is worthwhile to potentially inform trades with it, not necessarily entirely be the crux of in or out, but using it that way. So let's bring that to what we've seen recently, because for the last couple of weeks, we got higher levels of optimism. Now, it pulled back a little bit at the end of last week, but just a little, and was still well above its historical average. So we've gotten to where investors are kind of digging what they've been seeing out of the market as the market got back to record high levels again.
Yeah, we've actually seen bullish sentiment be above 40% for now 2 weeks, on Thursday's reading and then the week before. And this is the first time we've seen it since January. So it is above average. It's nowhere near extreme levels. It's within its typical range, but to see sentiment, really bearish sentiment, be above bullish sentiment for so long, to actually see bullish sentiment popping back up, it's a sign of, the pendulum swinging back towards optimism. But at the same time, to use a chartist term, we saw a golden cross, which is basically your 50-day moving average, which is a medium, shorter term trend, crossing over the 200-day moving average, which is a longer term trend. So we did see that actually going up right there. So we saw those two things on there. We've also seen short diffusion, which is basically how many people are long versus how many people are short. That fell to its lowest level of the year. We've seen the VIX pull back too. And again, the VIX is really just how much implied volatility are traders pricing into options contracts. And it's considered a fear gauge, because the higher the VIX is, the more traders fear volatile market conditions. And volatility can go either way. But with options, you want to make sure that your option actually ends where you want it to end versus having a big move that moves against you and causes your options to expire worthless, thereby, in that case, perhaps if causing you to perhaps incur a loss, or depending which end you're in, to actually rise in value and causing you to lose out in that direction.
We're going to get back to that in just a second. So let's put it all together from the standpoint of what we've seen the last couple of weeks with sentiment, and now with the sentiment investing gauge. Would this have moved it and moved the indicator? If you and I had talked 3 or 4 weeks ago, and we then went through this period the last week and a half, 2 weeks, where the things have changed, would that move the way someone is investing, or would it be telling people we're more risk on or we're more risk off? Because normally the more bullish the people get, the more it's a sign that, yeah, their timing stinks and bad things are about to happen.
Not that much. We did see it move to equilibrium. Our contrarian sentiment indicator moved to equilibrium. And I think that's where we're at right now. We're in a state of equilibrium. We're not, but we are seeing it actually move a little bit, towards the bullish side. So it's moving that direction from perhaps where we saw earlier this year, some of it being kind of negative, to more of a neutral type thing. So it's good when you see the market, when the S&P 500 rising to new highs, you're seeing coinciding type things into that. Yes, there's less fear here. People are turning to a more complacent environment. And complacency doesn't necessarily mean that it's overstretched. It just means that you've seen fear really reside on it. And now we're shifting towards being more optimistic, but not totally there yet. So we're not seeing the signal to really do anything or perhaps take a tactical move, just more of an explanation of what's going on in the market. And I think psychologically, just understanding what the trend in the market is, I think helps people be better long-term investors because it kind of gives them an explanation, kind of gives them a broader understanding of what's going on in the market and where things are at right now versus trying to guess. And I think it's important to realize a lot of market headlines are really built on trying to sway your emotions one way or the other, when in reality is it's kind of like baseball. A long time you were just sitting there with similarly not much happening, but you do see trends moving in one direction or the other. And all of a sudden you do have perhaps a big inning of baseball. In this case, you perhaps have a big, action in the market. And those are the times everyone, obviously the ballpark gets excited or everyone in the markets gets excited. And those times when people do get excited, and maybe opportunities for you to make some tactical adjustments to your portfolio.
Talking about tactical adjustments, you were at the Morningstar Investor Conference. I did not get there this year. And the Morningstar Conference is kind of an annual festival of what's new, right? You get the classic stuff and you get great managers or what have you who show up and get an award, but it's also always about this is what's happening and this is what's new. And in your answer a minute or two ago, you were talking about, using some of these indicators to help you inform your trades and potentially what you're doing with options. We are seeing a ton of options driven strategies. That is where a lot of the growth in the ETF space is. And I'm curious because you are with the American Association of Individual Investors. And individual investors, average individual investors, don't really fool around much in the options game. But they can, and you've taught them how to do it, and the organization's taught them how to do it. I'm just curious for those, because I get asked a lot of questions. Would you rather see the average person kind of, hey, you can do this, figure it out, do it yourself? Or would you rather have them go, okay, let me buy a fund that does a bunch of option stuff, and I may not fully understand how the fund works. I just know that, I wanted a little bit of covered call action or something like that.
I strongly recommend if you want to do options, buy them yourselves, understand what you're buying. The problem is we just did an article. There's, buffered ETFs that now use options and other ETFs too. If you don't understand what a basic option contract is, you don't understand how they're structured, you certainly should not buy an ETF that does them because you won't understand what's going on. You won't understand what the complexity is. And I know people who actually buy covered call strategies. It's basically you're selling options on stocks you already own in the hope that they expire worthless, that you get able to keep the premium. I myself tend to believe that most people are better off not using options at all. But if you think you want to do options, what I would encourage you to do is to learn how to do them, paper trade them before you do anything else. And when you paper trade them, actually go in your brokerage statement and see where they're actually trading at, because depending on the option, you have a pretty broad difference between the bid and the ask, and just start tracking it with fake money and see how it reacts, because options get especially option strategies get very complicated very quickly, and they look very easy to actually use when you see someone presenting them. But what you see in a presentation or webinar, what you incur in real life are two very different things.
Yeah, absolutely. And, people who tend to get into them, at least when they start, have just enough confidence to mess it up. And they certainly have the knowledge level to mess it up. And even in the option strategies, I so often find people who, when I ask them, what did you buy this fund for? They can't really tell me what the fund does or what it's supposed to do. They just kind of fell for the sales pitch.
Yeah, absolutely. I think one of the golden rule to investing is if you don't understand what the investment is, and it doesn't matter if it's a fund, if it's a stock, it's a bond, don't buy it. It's always easier to go from simpler to more complicated than to go more complicated and all of a sudden realize you don't know what the heck you bought. Just start with S&P 500 fund, very simple, very easy to understand. And then if you want to go more complexity, spend the time to read the prospectus, do research. And if you still can't understand what it is, then it's not the fund for you.
Anything else that you took away from the Morningstar Conference? Is there something new or next that's coming that we haven't heard about? Or it was another good conference, but one in which, what everybody's talking about is private credit, covered calls, options-oriented strategies, and all the stuff that's been very popular and that they're trying, and crypto funds that they're trying to get investors to buy into.
Yeah, I saw a lot about private assets. Morningstar is going to start providing more data on that. And keep in mind, when we talk about private investments, it's not just you're buying equity in a business. You can be buying loans. It could be venture capital. It's a big sphere and where it's getting a lot more attention, a lot more funds, and even funds that might actually be in your 401k are starting to allocate towards those. So I saw a lot discussed, a lot of it talked about, and I personally find it kind of interesting because I got my start in finance of valuing privately held businesses. And I talked to Morningstar CEO how I had to, when I did this, I had to consider, well, there's a discount because it's illiquid, discount because you don't control the decisions. So it sounds really sexy, but it's a big arena. And just because someone's saying you can do it doesn't necessarily mean you're going to get the best private assets or the best private credit. So if you're looking at it, go into it with eyes wide open and tiptoe slowly.
Charles, great stuff. Always is. Love the fact that there's more and always evolving tools in the AAII toolkit, and love that we get a chance to chat with you about all that you're doing and about investor sentiment. Thanks again for joining me on the show.
My pleasure.
That's Charles Rotblatt. He is the editor of AAII Journal, author of Better Good Than Lucky. You can learn more about him, the book, the Sentiment Survey, Sentiment Investing, and more at AAII.com. And we're just getting started on the July 14th edition of Money Life. Up next, we're headed to the baddest biker bar in the investment world, although it won't be that bad today. David Traynor is here. We're going to the not-so-dangerous zone when Money Life returns in just a moment. Stick around. Welcome to the best biker bar in the investment world. You've entered the danger zone. That's right. It's the danger zone, although it's the best biker bar because today you're going to get the other side of it. The danger zone is where we get the latest take from the experts at New Constructs, which is a unique research firm that has stock research that you really want to learn about because it's very different. It digs in at the footnotes level and works its way up. It brings together discounted cash flow analysis and forensic accounting. And it does this ultimately to find out where the numbers might be misleading. And then it puts all that stuff into a scale. Normally, we're talking about the dangerous end of the scale, because if something is misleading and it's going to lead you down the primrose path, that's dangerous. But after last week, where we talked about a dangerous stock, David Traynor, the founder and president at New Construct, promised he'd be back with the flip side. So this week, it's not the baddest biker bar in the investment world. It's the best one because you're going to get an idea that you might want to actually lean into. If you want to lean into New Constructs research, go to newconstructs.com. David Traynor, great to chat with you again.
It's great to be back, Chuck. Thank you.
So who's in the attractive zone?
Halliburton.
You're so good looking.
It's Halliburton, ticker symbol HAL. And what this is about, before I get to actually question, is that last week we were talking about stocks. Specifically, we were talking about Caesars, where the estimates were too high and you expected an earnings miss. So the flip side of that is estimates are too low and you expect an earnings beat. So help us understand why Halliburton is undervalued and good looking and why it's misleading to our favor.
Yeah, I'd like to also point out, Chuck, that more than half of the companies in the S&P 500 have understated earnings. And 30% of the S&P 500's earnings are understated by more than 10%. So people looking for a bullish signal out there, I'd say that's a good one for sure. With respect to Halliburton, what we see here is mostly unusual expenses. First of all, there's unusual other expenses in the trailing 12 months that comes out to around $200 million. Another $200 million in impairment charges, $170 million in severance costs, and then another $120 million in SAP S4 upgrade expenses, $35 million in cybersecurity, $8 million loss on blue chip swap transactions. So a bunch of stuff that we dug up to recognize as one time. These are things I got to do once. So they're not really part of the ongoing profitability of the business. When these things go away, earnings will pop back up.
What this means is that when we normally are talking about a stock, giving you a picture where you say, hey, the no growth value of the stock is so much lower than what the stock is trading at, that we now have a picture with Halliburton that it is undervalued. So, how much are the numbers on Halliburton suggesting that this stock should be worth or might be worth rather than where it's at now, which, by the way, is about 22, 23 bucks a share?
Yeah. Now, Chuck, I want to make sure, take one step back here. Earnings distortion, positive or negative, does not necessarily correlate with the overall rating. So we do earnings distortion scores. Halliburton has a beat score. That doesn't guarantee it also has an attractive rating. Now, for our special report on the stocks most likely to beat, we made sure that they had a earnings distortion score of beat or strong beat and an attractive or better rating, but it's not necessarily guaranteed. But in the case of Halliburton, we're seeing a price, to your question on Halliburton, we're seeing a price to economic book value of 0.6. So the economic book value is significantly higher, about 40 bucks a share, while the stock price is 22 bucks a share.
You always tell me the catalyst is unknown to you. Your crystal ball has not been repaired. With an earnings miss, what we were talking about last week with Caesars, well, you know, at some point, if the numbers don't hold up and you have that miss, there's your trigger. Is it harder on the upside to have a catalyst?
No, not necessarily. Not necessarily. You get a beat, and look, with Halliburton, I think there's, given the amount of uncertainty with respect to energy prices and the energy sector, stock's going to probably be beholden to some of the macro news in a lot of ways. But there's no reason a really strong beat here wouldn't cause the stock to spike up. There's clearly a lot of room for the stock to go up. I would also say that I think economic book values are probably a little bit high historically, given that oil prices have been coming down here recently and are more likely to be flat to lower than they are to be higher. But you're still looking at a business that looks very much undervalued to us.
Why does Wall Street have a tough time factoring out one time expenses and things like the distorting factors you talked about?
Oh, Chuck, where do I begin? Great question. Wall Street's not really in the business of providing great research, right? That's not how they make money. Wall Street makes money selling stock. So, look, I've been doing this work for a long time. I can tell you, hand on heart, Wall Street doesn't want people to know the real numbers. As soon as everyone has access to the real numbers and there's one version of the truth, well, then they can't use whatever number they need to get that Beyond Meat IPO done, or that Peloton IPO done, or fill in the blank WeWork deal done, right? And so it's just not what they do, and there's plenty of studies that have been published, and I refer to them on a regular basis that point out that companies fudge the numbers and Wall Street looks the other way. They know it and they don't do anything about it. And it's just funny. I was having a conversation with another friend around, how early in my tenure in Wall Street, I did some work for some investment bankers and they didn't really use any of it. And I came away with the epiphany that, oh, yeah, the bankers can find a ratio to make any deal look good. Why? Because they're selling deals. So that's what they do. And I think we've seen that proven time and time again on Wall Street.
But wouldn't Wall Street benefit from this company getting to a value that is more in keeping with what you think it is? I mean, if this stock realistically, without doing much, has the potential to be a $38 stock or what have you, basically taking the current price and dividing it by zero point 0.6, which is the math from the numbers you gave us earlier that I would be doing, and that puts us right by that target. Doesn't Wall Street benefit from this stock reaching its fair value as opposed to being where it is?
Yeah, great point, Chuck. I mean, you can definitely make the case that there are instances where it make a lot of sense for Wall Street to come out and say, "Hey, here's the truth. The truth works for this company," but then they risk killing the golden goose because the truth usually doesn't work. And if they can get away with never really revealing the truth, and look, Halliburton's not a sexy stock for them. Makes a lot of money. It's not going to be an investment banking client, right? They don't need to go raise debt and equity to cover losses. It's part of the reason why stocks on the zombie stock list can sometimes go the opposite way, because they'll get plenty of funding, because they'll get Wall Street support, because Wall Street makes money getting them their funding. So Yeah, and every now and then you see it. You see an analyst here and there do it, but as an industry, systematically adopting a superior form of research, not going to happen because they all know they don't want to kill the golden goose here. And the golden goose is misinformation that provides cover for selling way more stock than should be sold.
It's interesting how it all gets put together, but in this case, it's particularly interesting that we got both sides of the coin. Again, last week it was Caesars, CZR, as as one of the most likely stocks to miss. And this week it's the flip side of that. It's missing because it's too low, which means it's likely to have a beat, and a beat at some point would be very good for the stock of Halliburton, HAL, the pick in what we have to call the attractive zone this week. David, great stuff. We'll talk to you again next week.
My pleasure, Chuck. Good to be with you.
David Traynor is founder and president at New Constructs. Go to newconstructs.com to learn about all their research, find out about their most attractive and most dangerous lists, and more. And we're not doing anything that's too dangerous. We're going to take a quick break, and then we'll be back with Brad Case. He is chief economist at Middleburg Communities. We'll be talking about housing economics and things like that when Money Life returns in just a moment.
Oh, wow. This is actually pretty dangerous.
Verify is the partner asset managers rely on across the entire product lifecycle. Learn how you can build and support the product of your dreams at verify.com.
Welcome to the big interview on the July 14th edition of Money Life. Joining me now, Brad Case. He is chief economist at Middleburg Communities. And Middleburg Communities develops and invests in institutional quality build-to-rent communities, also traditional multifamily properties. So very much on the real estate side of things and the rental market side of things, although he goes beyond that if you've read any of his papers. And if you haven't read his papers, but you want to, and you want to find out more about what he does, Middleburg.com is the website for Middleburg Communities. Brad Case, welcome to Money Life.
Chuck, I'm happy to be with you.
Let's start with your take on not so much the broad economy, though we'll probably get there, but the housing economy, because there has been a lot of talk about how much housing stock we have, what is going on, and it's a pretty vital piece of the big broad economy. So let's start there in terms of your outlook and what you see happening and how healthy things are right now.
Yeah, the last 5 years have really been kind of a weird situation for the housing market generally. 5 years ago when COVID started, a lot of people suddenly wanted to move into bigger places or places in parts of the country where they could afford more housing because they were working at home. Or if they weren't working at home, they were certainly spending more time there. So a lot of those people moved to the part of the country where my company is active, which is sort of the Mid-Atlantic and the Southeast. And what that meant was that suddenly there was this huge shortage of housing throughout the country, but especially in my part of the country. And that caused rents to go up. And then companies like me responded right away by building more housing. And again, especially in the Southeast and Mid-Atlantic. And so there was a housing construction boom, and that has basically passed. But as a result of that, rent growth has been essentially zero over the last year or so. We're now getting back into a much more normal housing market.
Yet we still hear of housing shortages, apartment shortages, how tight the market is. I'm wondering, is some of that the housing equivalent of what we're seeing in the broad economy with soft data and hard data, where you ask consumers how they feel and they say, I feel terrible. But then you look at their spending numbers and they're still spending. Is that part of the issue, is that people are still grumbling because when it comes to their house or the place they're renting, they're just always going to be complaining?
I don't think that's really something that's affecting the housing market. What's really going on is that before the early 1970s, and especially during the period following World War II, there was a tremendous construction of housing because there was tremendous growth in the number of people who wanted to get their own place, whether it was buying or renting. And so we had a big increase in the number of households. And a lot of those people were people who had been doubled up with their parents or their friends. They moved out on their own, got their own place. And housing was built for them. But starting in the early 1970s, we stopped having that large amount of new housing construction. And then what happened in this century was that in the first part of the century, actually, the number of households went down because there was such trouble in the owner-occupied part of the housing market. People who had stretched to buy a house lost everything, went bankrupt, and they moved back in with their friends or their parents or whatever. Then, starting 10 years ago, we started to see an increase in the number of households again. In fact, even more rapid than what we had seen after World War II. So there's been a huge increase in demand for housing over the last 10 years and we haven't had the construction to meet it. So aside from the little bit of a construction surge just over the last few years, we really have had a shortage of housing, of new housing being built really for 50 years. And the people who are suffering from that are the young households who are trying to move out of their parents' basement, trying to move out of, sharing a house with their fraternity brothers and their sorority sisters. Um, and whether it's trying to rent a place or trying to buy a place, there just aren't enough housing units available for them. And so, especially in the owner-occupied part of the market, it's simply become too expensive.
Is the problem, and especially the cost, because you've got a shortage and we know how supply and demand works, exacerbated by what we're seeing with tariffs? I mean, so many building materials come from Canada and Mexico, just for starters. Is that going to make the problem worse for those folks who are at least looking?
It may make the problem worse. What we've seen so far is there's been a cutback in construction, and I don't think it's really because of the tariffs. I think it's really because of uncertainty, and also because interest rates are higher than they were, 5 or 10 years ago. But going forward, it is possible that those tariffs really could make it more costly to build things. Now, my company is an example of a company that has put a lot of work into sort of setting up our supply chains so that we won't be affected very much, even if those high tariffs kick in and stay around for a long time. But other builders really are affected pretty dramatically by it. So when you think of the overall housing situation throughout the country, yes, the tariffs may end up being very important, but not for everybody. And I don't think that you can really blame the current situation on the tariffs yet.
In there, you mentioned interest rates. It would be hard to talk with an economist and do my job if I were not asking about what you think about where interest rates are going and whether you think the Fed is waiting too long.
I don't think they're waiting too long. There are a lot of people in business who like lower interest rates, period. I'm not one of those. To me, if interest rates are too low, then you get a lot of people spending money that's wasteful. That's, they're investing in a project that doesn't pay off except because interest rates are so low. So when interest rates go up, which is what they've done over the last few years, a lot of people are simply out of business. It's just not worth it for those people to build housing because of the interest rates. For other companies like mine, we're going to be building housing even when interest rates are higher because we're looking at projects that are going to pay for themselves even with higher interest rates. So it doesn't really affect us, but it does clear out the people who really don't have much business being in the business. It really gets us back to the people who basically know what they're doing. So I'm actually not in favor of low interest rates in general. And in the current situation, there's still a lot of uncertainty as to how the economy is going to develop, but there's still way too much risk that inflation could reignite. And for anybody who was around during the late 1970s and the early 1980s, interest rates right now are nothing compared to the 18 or 19% they were back then because inflation had gotten so high. Nobody wants us to be back in that situation. So people who are saying interest rates should be brought down, they should really think twice before they argue for something that could dramatically stimulate higher inflation.
Do you believe the Fed will be cutting and that there will be the right time here coming? Or do you think that given economic circumstances, they can hold off because things keep looking strong?
I do not think that they will cut rates at their next meeting. I think in general, they would like to be able to cut rates before the end of 2025, but at least by 25 basis points, maybe by 50. But they're waiting to see whether the data sort of give them permission to do that. Because as I said, they're very conscious that if they allow inflation to go back up again, Not only did they fail to do their job, but it would make their job harder to do. So I don't think that they will cut that. I don't think they'll be too quick to cut interest rates. I think they would like to cut interest rates, but they will wait for the data to give them permission.
You've done some research and recently wrote a white paper that talks about renting versus owning a home. It points out that renting is a lot better than people necessarily give it credit for. Maybe folks will not be surprised that you reach that conclusion when they recognize you work for a company that builds rental properties and builds multifamily housing, and they'll think that's what you had to come to. But the numbers that you focused on are something that I've talked about for a long time, which is that historically, the rate of inflation or the rate of growth in housing prices winds up being about 3% a year. Now, if you own a house at the right time in the right place and you buy it and wind up flipping it as the market gets hot, you're doing a lot better. But if you buy a house to raise your family in, you're going to wind up somewhere in that 3, 4, 5% range. And the market has historically done better. Take that case just a little bit further, because it would suggest that for those folks who worry that they can't achieve the American dream, they'd be better off trying to achieve it without buying a home.
Well, you're exactly right, and you put it very well. If your goal is to build wealth, then you want to invest in something that is going to help build your wealth over a long period of time. Don't be a day trader and try to build your wealth in one day. What I advocate is for people to try to build wealth over the 40 years or so that they plan to be working. If that's your goal, then the best way to do that is to put as much money as you can into the stock market. Now, many people will have some invested in the stock market and other money invested in, bonds or something with a little bit more steady earnings. The thing about housing is the basic return on housing net of inflation is almost zero. And so, a lot of people who argue that you should buy a house to build wealth, what they're really saying is pay me because I'm a broker. And often what they'll say is, yeah, but if you buy a house, that's a levered investment because you're borrowing most of the money to buy the house. And that's fine, but it's a levered investment in a very low return asset. The other mistake that people make when they think about buying versus renting is they compare only the check that you write each month for rent with the check that you write each month for mortgage principal or principal and interest. And when you buy a house, there's a lot more going on than that. You buy a house, you have to cut a separate check for the property taxes. When you're renting, that's included. You buy a house, you have to cut a separate check for various amenities like the neighborhood pool. When you rent, that's included. When you buy a house, you have to pay somebody to repair anything that gets broken, or you have to put in the time to do it yourself. When you rent, that's included. So when you take into account all of the costs of owning versus all of the costs of renting, and you take into account the fact that when you rent, you don't have to put together a huge pile of cash to put into this low return asset, and instead you could put it into the stock market, that's why you build wealth when you're renting. When people hear this result, they are angry because they are so wrapped up in the idea that if I am going to prove that I've been successful, the only way to do that is to buy a house. Well, if you want to prove that you're successful, get wealthy. And if what you're doing is buying a house instead of getting wealthy, then what you've done is you've gotten yourself saddled with a very low return asset that's very risky, because you could be one of those people who went bankrupt in 2009, 2010, because the value of their house suddenly wasn't going up the way they thought they would, and they didn't have the wealth to back it up. So they not only lost their house, but they also went bankrupt. Don't be one of those. As I said, if you want to build wealth, then that's what you do. You build wealth. And the way to build wealth is to put as much money as you possibly can into the stock market or into other high return investments, and stop sending all your money to those brokers.
Of course, the folks who don't get angry, who try to stay reasonable about this, would say, okay, there's at least a point in your life where you might want to have a home for other reasons, where you're going to raise your family, et cetera. And it's less about the investment value and more about the, I want a use asset that I control and I have all those sorts of things. So what I'm more interested in is something that I think will affect a number of folks in the audience who are of similar age to me, which is when they decide that they want to give up the house, either they want to downsize or they want to do whatever, we still have in this country a lot of folks who will say, okay, now I'm going to go buy the condo or buy the place in the senior community. And there they have less time to build wealth, etc. How much does this apply at that point? And does it really mean that for most people, if you want to make the house decision, great. But oh, by the way, at the end of your life, are the numbers the same? Do they work the same? Or does your time horizon and other things factor in so that somebody who's looking at renting versus owning when they're 70 is looking at a much different picture than somebody who's doing it with their first home when they're 30?
Oh, that's exactly right. And what you pointed to is the fact that when you buy a house, you're making two decisions that you need to think about separately. One is an investment decision, and that's what I've been talking about. If your goal is to build wealth by investing, then housing is the wrong thing to invest in. But the other is a consumption decision. And one of the problems with buying a house is that you tend to buy a lot more house than you actually want to consume. And that's why at the end of your life, you're looking to downsize into a condominium or something like that. When you are of an age where it's not the investment aspect of housing or anything else that is really driving your decisions, but rather I need a place to live and I want it to make sense. It doesn't matter to me whether you buy a condominium that fits your housing consumption needs or rent a place that fits your housing consumption needs. As long as you're thinking of those as a consumption decision, it'll be hard to make the wrong decision. It's when you think of housing as an investment decision that you tend to make the wrong decision.
How does the increased use and availability of things like reverse mortgages play in? Because again, that is an investment decision, but it is also a consumption decision. I want to be able to stay in place and somehow access the money that I've tied up in the house.
Yeah, I'm actually a real fan of reverse mortgages in general. There are, of course, bad products out there that come under the heading of reverse mortgages, but there are also very good products, and it's a very good way to set yourself up if you did buy a house earlier in your life and most of your wealth is tied up in that house and you just don't have the wealth invested in the stock market. If you made that decision a long time ago, then a reverse mortgage is a terrific way to get out of what may have been a mistake a long time ago. But you have to keep in mind that one of the mistakes that people tend to make if they own a house is, well, my children grew up in this house. I want to give them the house. That's not the right way to treat your children. What you should do for your children is to give them money because they can use that money to go get housing in whatever city they want to live in and in whichever neighborhood of that city they want to live in. And you don't want to tie them down to the house that they grew up in. Now, I grew up in a very nice house. I would love to live in the house that I grew up in, but it's in the wrong city by about 5,000 miles in my case.
Of course, if your parents gave you that house, you could sell that house and then use the money. It just leaves the burden to you and eases it from your parents in a case like that. So I can't be too critical of the parents who were doing that, other than why would you leave your kids a burden?
Yeah, with my own children, what I have been doing is trying to make them gifts that and show them how to invest that in the stock market. If they buy a house, fine, that's their decision. I am not hoping to help them buy a house. I am hoping that they make good financial decisions. And to me, that probably means that they should be renting.
Does that also mean that as a renter in that case, by making good financial decisions, they're finding ways to invest whatever they're not spending on the house? Because it's a very different thing if you go, okay, I'm renting, it cost me $1,500 a month. My mortgage was going to be $1,500 a month. I would spend that extra stuff, but I'm not saving the extra money that I'm doing. I'm blowing that on my lifestyle and whatever. If they do not save that money, how does that change the equation?
What you're giving is what is often given as a reason to buy. It's like I am so irresponsible that if I buy a house, it'll make me responsible. Well, those are exactly the people who go bankrupt. If you're trying to force yourself to be responsible by dropping 7% of the purchase price on just the brokerage fee, and then saddling yourself with an asset that's going to take months and months and months to get rid of if you decide that you want to move to a different city for a better job, you have set yourself up for failure. And that's never a good idea financially speaking. So don't look at your house as the way to make you suddenly irresponsible if you just basically haven't developed the ability to make responsible financial decisions.
I agree with that, but I know a few people who have always told me they struggled to save, but they never struggled to pay their bills. And so, not so much with their house, but with like, oh, I can save using insurance because I'll never let my policy lapse and I'll pay it every month. And yes, I can look and say it's not the ideal decision because they could have done better and been certainly more efficient had they done it directly. But it did give them the outcome that they wanted, which was a considerable nest egg at the end of it, et cetera. So I still do worry that you're right. It doesn't make you responsible, but the math does change. Like you still are responsible for building wealth. If you don't do it, if you're a profligate spender the other way.
Yeah, I've even heard people make a similar argument with respect to credit cards. If I build up the amount that I owe on my credit card, then that will force me to be responsible about paying down the credit card balance at the end of each month. I don't think that's a very good argument, but I have heard people make it.
Yeah, that one I buy a lot less. I have never seen anybody who routinely is killing themselves in credit card debt and doing it because they're spending badly. But really interesting. So then one last question in all of this, since we've been talking about the economy, et cetera, which is when do the home buyers who are currently renters wake up to this? Because there are plenty of studies. We've talked about them on a number of occasions on the show. Talk about how people are buying houses, then coming away with regrets because they didn't quite figure out how much they were going to spend in real estate commissions or closing costs or escrow or whatever it might be. At what point do people wake up or come around to your way of thinking in a society that is so driven by home purchases?
Well, I think that the regret increasingly comes not from how much it costs to buy the house, but the realization that it really locks you into your current job, or at least your current city and probably your current neighborhood. Our society is so much more mobile now. People want the ability to move to a different city because there's a good job there, or because instead of having to live here because this is where my job is, I may be able to keep my job, but work from home. And why should I live in this city if I'm going to work from home? So when you buy a house, you're tying yourself to that location. I mean, obviously you can move, but it's very expensive to move. And so I think that when we look at the number of young people who are choosing not to buy, or certainly waiting until much later in their life to buy for the first time, I think that's a large part of the reason. They understand that they're at a stage in their life where they want mobility because that's how they increase their income, by moving from one job to another. And the good jobs are not always going to be where you started your career. The good jobs are going to be in places where the companies are moving to. And so the regret, I think, is increasingly coming from the fact that they realize they tied themselves down.
Brad, really interesting discussion. I'm glad we had a chance to have it. Thanks so much for giving me the time and joining me on Money Life.
I enjoyed it, Chuck.
That's Brad Case. He is chief economist at Middleburg Communities, which is online at middleburg.com. And if you go there, you can find his piece that talks about renting versus owning and makes that case. And you can then have that discussion with the people in your life. And we're just about done with our discussions on Money Life today. We're going to take a quick break, come back and put a bow on this show, but we will set you up for the rest of the week. There's a whole lot of guests coming that we hadn't told you about. So you're going to want to know what the dance card looks like before you get away. So stick around. The end is in sight. We'll cross the finish line together in a moment.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
We're back. Thanks so much for sticking around to the end. You know, interesting when you get a corporate economist, right? We spend a lot of time with guys who are economists on the level of an investment company, which is different from being a corporate economist. But I can't say that it gives you different research. Like, I think any economist might come to the same conclusions you heard Brad Case come from, but you have to question when you hear somebody saying, well, buying a house is worse than renting, when they're in the business of selling rental stuff. And that is the business he is in. But as I said in the questions, I've long said that your house is not your best investment for most people because the historic rate of return is not very high on real estate. But that doesn't mean you shouldn't own a house. It just means you should factor that in. So interesting discussion. Let me know what you thought. Let me know if you want me to try to get more of those kinds of guys, because I don't always take the corporate economist. Now, I don't have to. Like, we'll have another economist on tomorrow. His name is Howard Yaris. He's a professor at New York University, the author of Understandable Economics. He'll be on tomorrow's show. By the way, so will Mark Newton from Fundstrat. He is the global head of technical strategy at Fundstrat Global Advisors. And Hank Smith, the head of investment strategy at the Haverford Trust Company, will be here for the market call. And it's going to be a big week. I know last week I didn't tell you everything that was coming. Well, buckle up, because on Wednesday's show, Nanette Abahoff-Jacobson, global investment strategist for the Hartford Funds, and Michael Guyette of the ATAC Funds and the Lead Lag Report. But also coming this week, Bill Davis from Stance Capital doing the market call. Eric Marshall, president, portfolio manager for Hodges Capital Management. He will be here, and much more. So plan to be here because we've got great things planned for you. Meanwhile, if you are looking for something to celebrate, today is National Nude Day, which I guess is for nudists or people who don't want to wear clothes. But the irony of this, perhaps, is that if you wanted a reason not to celebrate National Nude Day, it's that today is also National Tape Measure Day. I'm not making that up. Alvin Fellows of New Haven, Connecticut made the lives of carpenters, electricians, seamstresses, countless other craftsmen and tradesmen easier because on July the 14th, 1868, he was granted a patent for improvements in tape measures that created the retractable tape measure. Yeah, but to celebrate Tape Measure Day on Nude Day? No, that's just a cruel joke. On the food front, it is National Mac and Cheese Day. You can wash it down with some alcohol because it's National Grand Marnier Day. My guests today were Charles Rotblatt, editor of AAII Journal, which is online at aaii.com. David Traynor, founder and president at New Constructs, online at newconstructs.com. And Brad Case, chief economist for Middleburg Communities, which is online at middleburg.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Texas Dolly, Doyle Brunson, a poker legend who died 2 years ago today, and who said, "A man with money is no match against a man on a mission." Well, be on a mission with your money. Try to make sure that your money's doing what's best for you and try to keep everything in perspective. And to do that, remember that until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great day, everybody. Stay safe and stay calm. We'll see you here again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
You come to any conclusions yet?